Yo, what's up, everybody? What's up? Welcome to the first episode of Road to a Million with Curtis G. Y'all could just call me G or call me Curtis G. I am the CFO of Young Black and in Business. And what we're presenting to you guys is a bi-weekly or twice a month show on Mondays where we just chop it up about the stock market, passive income, investing, financial news, things of that nature. And so week to week, I'll be as transparent as possible. Everybody will be able to see my portfolio, the things that I'm investing in, the money that I put into my investments, and how much passive income I am getting back in that portfolio. But to lay the groundwork, right, to get us all on the same page to understand Road to a Million, I really want to start off with the basics for those of us that might not know anything about investing, those of us that might not have any idea about stocks and dividends and passive income. So we're going to start off this first show just as a base foundation. I got a presentation lined up that we're all going to go through. We could check it out together. So you guys get on the road with me. Road to a Million, Curtis G, Young Black and in Business. And let's get started. So I'm going to go ahead and share my screen here. And we're going to rock out on this presentation. So this is the Road to a Million presentation. And we're just going to go through, right? So the first thing, disclaimer, notice that I'm not a financial advisor, stockbroker, licensed by the SEC. This following content is strictly for informational, educational, and example purposes only. My name is Curtis G. I've created this journey called Road to a Million, where I want to show people my progress and encourage people to join with me, starting from zero, working my way all the way up to $1 million, whether that's $1 million in cash, $1 million stock investment portfolio, or $1 million in revenue in 1 year. That's the journey. So it could be any combination of those, right? You could have a house that's worth $500,000 and $500,000 in the bank, or you could have $1 million in the stock market, or any kind of combination. But the goal is to get to that 7 figures to $1 million. Definitely starting from zero. So what you'll see when we do these weekly meetings and we're discussing the stock market news, I would try my best to be as transparent as possible. This right here on the screen is a screenshot from July 1st of 2020, where I went to zero with my stock market portfolio, and over time, just building it up bit by bit, day by day, week by week, month to month. And I want to show you guys this real life time, this real life experience, this tracking. And the reason why I want to show you guys this is because you have the ability to take a look at what I'm doing and then say, you know what, I really like what G's got going there. I'm gonna kind of follow suit. Or you can say, look, the way that he's doing it is taking too long, or I would have did this better. I would have switched it over this way. But we all get this real life kind of like example, this experience in real time for all of us to make a decision on this road to $1 million if you want to do things better. Or you guys can hit me up and be like, yo, G, I really like that. Can you give me more info? That's what this whole thing is about, us coming together as a community on this road to $1 million. So we're going to work as a team, with me kind of being like the live example that we all can use on this journey. All right, so the reason why I say building it like a team, right, road to $1 million, I equate that to everybody that is off to the side, right? Everybody that is off on a Formula One raceway. When the driver pulls up, you've got a team of people right there to change the tires, hook up the car, and get the driver right back on the road, right back on the raceway in the Formula One, which you're about to see here. And the reason why I liken it to this example, right, building a team that can share ideas and educate each other with passive income and investing, is you'll see here, with more people on the team, the faster the individual drivers can get going back on the road. So just take a look. And this is exactly what I mean by building a team on this road to $1 million, similar to a Formula One racing pit crew. All right, so you guys, you see it there, right? You see it right there. You see how quick, with a team of people on standby to get the individual driver back on the road, back onto their journey, back onto their goal, back onto their race. And that's exactly how I want our community of Road to a Million to be. All of us coming together, everybody sharing ideas, sharing education, and growing together to get us where we want to be, a million sooner rather than later. Obviously, it's not a race where we have to just rush. We can take our time on this journey. But what you see there is with a team of people, we can get moving faster. So that's what the Road to a Million community is about. That's what I want to build with you guys. So let's really chop it up and let's get in. And we'll get back to this presentation, just covering the basics for those of us that are just starting out. Okay, the basics. So the basic, easiest form of passive income that I believe is dividend income. And so a dividend is basically money that's paid out from a publicly traded company. So Coca-Cola, McDonald's, those companies that are listed on the stock market where you can buy shares of. If you buy shares of these companies, they will actually reward you because you officially become an owner when you buy shares. They'll reward you with a payment that's called a dividend. You could literally take out your phone, download an app like Fidelity, Webull, Robinhood, E-Trade, put money into it, buy some shares, and within the next 30 days, you could start getting passive income, dividend income. And it's my favorite form because it's the easiest. Obviously, on the Road to a Million, we will be discussing rental income, rental properties, things of that nature. But I think the easiest way to get into the game to get passive income is through dividends. So a dividend basically is a reward that you get for owning shares of a company's stock. It can be paid monthly, quarterly, twice a year, or annually. And it's important to note that not all companies pay dividends. Typically, the companies that you see are what they call mature companies, companies that have been around for a while. Like I said, your Walmarts, your Coca-Colas, McDonald's, things of that nature. Okay, so like I told you guys, I'm gonna be as transparent as possible. And I want you to do me a favor right now. Take a moment right now, pull out your phone, get on your banking app, and go take a look at your savings account. Some of us might have money market accounts, but go look at your savings account and take a moment to see how much money or interest did the bank pay you for your savings account. Basically, you've been saving up your money, being responsible. We all know that savings accounts are supposed to get interest. And so take a moment, pull out your phone and check it out. And the reason why I want us to check out the savings account interest, what we're making on our money just sitting there, is because we have a live example from my portfolio to check it out. So here, as you see, this is a screenshot of my bank balance going into the new year, 2021. This is December, January going into the new year. And this is specifically actually a credit union. And those of us know like credit unions kind of have that stereotype, right? That they pay better interest, they have better rates. So this right here is my savings account at my credit union with a balance of about $7,000. And you can see from this screenshot that they gave me 11 cents in an interest payment. They call it a dividend. That's because credit unions consider their members, their account holders as owners. But really, this is just a savings account interest payment. So for the $7,000 that I had sitting in this account, they only gave me 11 cents. And when you multiply that by 12 months, that means after 1 year, I'll have $1.32 for my $7,000 sitting there in that account. So that's why I want you guys to check that out, just to hold that in your mind, to keep that in your thought process as we get into buying stocks and stocks that pay dividends more specifically. You got your savings account, check out the balance. You see here at $7,000, only got $1.32. But at the same time, going into the new year here, July 24th, my balance in my portfolio was about $8,300. And I was forecasted to get $489 for the year. So basically $490. And these are all the dividend payments that I received from the companies that I've invested in. So you can quickly see that there's a disparity here. It's crazy. It's crazy. 7,000 to be sitting to only get $1.32 a year, or I could put that money into the stock market, $8,300, and now I'm almost getting $500 a year in passive income. That $500 is your car registration each year automatically paid for, or your Netflix membership covered for the year, your Amazon Prime membership is covered for the year. So you can quickly see how that passive income, your money working for you, can start to pay for different things in your life, right? So here's just a snapshot of all the different companies that I'm invested in. You'll see that I get paid every few days nonstop, whether I'm asleep, whether I'm working, whether I'm on vacation, nonstop every few days. I get these dividend payments and they're growing and growing. So you guys can take a look right here. So you see there, all of those payments going back to November, December, every few days, I'm getting paid passive income from the different companies that I'm invested in. Those are the dividend payments. I bought shares in these companies. They pay out the dividends every few days, and I'm just kicking back, collecting income. A lot faster, a lot better than just having my money sit over here in the bank. Okay, so one of the things we want to talk about when investing in dividends or buying shares of stock or stock in a company that pays dividends, we got to understand the key terms. So as we get started on this road to $1 million, I just want to lace you guys up with some key terms that some of us might not be aware of. So we'll get through a couple of examples and then we'll get back into some of the live experience with my portfolio. But this right here is to get those of us that might not know or understand dividend investing. We might not know the key terms. We might not be that familiar with them. We're going to go over that together. So one of the most important terms that you're going to hear when buying stocks that pay dividends is the dividend yield. So right here, we got a snapshot back from February 19th of a company called AbbVie. AbbVie is a big pharmaceutical company. At that time, they were trading at $105 a share. Their dividend yield was 4.9%. Now, you can think of the dividend yield, right, as bang for your buck, or almost like kind of like return on your investment when it comes to the dividends portion specifically. So what this means is for every one share of AbbVie that you buy, you're going to get back 4.9% in dividend payments, right? Now, just think about that when you go back to your savings account where your money's sitting there and what the bank or the credit union is paying you. For those of us that kind of aware of interest rates are not this high. You know, people are getting less than 1% on their savings account. So here I could give AbbVie $105 and get 4.9% bang for my buck. And that equates to $5.20 a year annual payout. That's another term that you want to be familiar with, the annual payout, which is the total amount of money that you'll get in 1 year in dividend income from this company. AbbVie will pay you $5.20. So you can see automatically, I'm automatically ahead of the game. I could buy one share of AbbVie at $105 and be way past what I would get in a year from my savings account with the $7,000 in it. One investment, $100, I'm beating my savings account. Savings account is just blown out of the water. Boom. Now you're getting started on that road to $1 million. Very easy, very fast. That's why I said dividend income is the easiest form of passive income. You can literally download an app, take $100, and now you're getting more than all the money you got in your savings account. Now, the next term that's very, very important that we want to focus on is the payout ratio. This number is extremely important when you're looking at companies that you want to invest in, right? So your payout ratio basically is a percentage of how much the company's having to pay back out to their shareholders in dividend payments, right? So for AbbVie, for every $1 that they make, they've got to pay out 42% or 42 cents. So this number becomes very important because when you're looking for companies to invest in, you don't want this number to be too high. The closer this number is to 100% is more of a red flag. And the reason why that is if you've got a company with a payout ratio of like 85%, 90%, that means that for every $1 that they make in revenue, most of that money is going back to pay their shareholders. And you might be thinking, well, why is that a problem? It becomes a problem because now the company doesn't have enough dough. They don't have any money to expand their operations. They can't develop new products. They can't come up with new services. They can't get more market share. They can't make more money. And if they can't make more money, then they're getting to a position where they can't continue to pay the dividends. So you want to keep a close eye on this. Now, there is an exception to this rule, but as a general rule of thumb, when you're looking at dividend companies to invest in, you don't want this number to be more than maybe 70%. Obviously, you'll develop your own threshold, your own taste level. But for me, I kind of recommend, for my own personal investing, I like to keep this number below 70%. Then the next thing you want to pay attention to is the growth rate. This 5-year growth rate is a key number. It's kind of like industry standard. People will look at a company, at least for the last 5 years, to determine whether or not they've been increasing their dividend, because that lets you know, okay, not only Or am I getting paid dividends, but they're increasing it? And the reason why this is important, there's a real important reason for this, is because of inflation. As inflation gets kicked up, you want your money not only working for you, but working harder to keep up. So this $5.20 could be more next year off of that same one purchase that you made. So you make a purchase today in 2021, you buy one share, you're going to get $5.20 back from AbbVie. And then they're expected to grow that next year. So that's going to have your money keeping up with inflation. Dividend growth is another term you want to be familiar with. And that just shows in the last X amount of years, in this case, in the last 8 years, AbbVie's been growing their dividend. So it's looking really good. You're getting paid more than you would get in your savings account. And that money is going to grow on its own, which is really crazy. You can make one purchase today, and for the rest of your life, as long as AbbVie pays, you can expect that dividend income, that dividend revenue to increase on its own. You don't have to do anything. All right. Now here, the bottom half of this screenshot is the specific details with the most recent dividend. And what this tells us is that for the last announced dividend that AbbVie told the public, they said for one share, they're going to pay you $1.30 right here quarterly. That's once every 3 months. So if you did $1.30 times 4, you would get $5.20. So once every 3 months, AbbVie's going to give you $1.30 for that one share that you buy. Already in that very first time I get paid, that very first quarter, I will get more money than I got in the savings account that we just talked about. Next important term is the ex-dividend date, right? So the ex-dividend date is the day that the door closes. And what this means is, hey, as a share owner or a shareholder, you want to have your shares purchased and owned by you before this date. Pardon me. You want to have these shares owned and purchased before this date. If you try to buy shares after this date, the day the door closes, or on this date, the day the door closes, you won't qualify for the payout date, which is May 14th. So you want to have your shares purchased May or April 13th or earlier. So the ex-dividend date is the date that the door closes. You get paid out May 14th. So you see, it's really easy. You get started and start getting money right away. And this is why I like dividend investing for passive income. All right. Then the declare date is basically the day that they told the public. They said, hey, we checked out our numbers. We looked at the cash that we got. We looked at our revenues. And we're telling the public today, February 18th, that we can pay this dividend. We've got all our numbers squared away, and this is what we can do. All right, let's check out one more example. All right, Realty Income Corporation. So we went over all those terms. We see that Realty Income Corporation is trading as of February 19th. They were at $61 a share with a dividend yield of 4.62%, meaning basically bang for our buck. That's the return on investment we'll get in the form of dividends, speaking specifically just the dividend income, right? But what we see here is they've got a high payout ratio. It's looking kind of crazy. Now, if you remember, I just said a few moments ago, there's an exception to this rule. There's an exception to the payout ratio, and that is for companies that are called or qualified as REITs, real estate investment trust, REITs. Now with REITs, they've got an agreement with the government, right? They got an agreement with Uncle Sam that says, as long as you pay out most, anywhere from 85 to 90% of your revenues back to your shareholders in dividend income, you guys get a huge tax break. You don't have to pay taxes. So the exception to the rule, when you're looking and you're doing your research on a company to invest in that's paying dividends, if it is a real estate investment trust or a REIT, then you can expect, or you should be looking for this number to be closer to 100% or 90% or in that range. And of course, you see that they've been growing the last 5 years. They've got a dividend amount of 23 cents. So here, if we buy one share of AbbVie at $61, they're going to give us 23 cents monthly, every single month. Ex-dividend date was February 26th, meaning that we had to have our shares purchased and owned February 25th or before. Payout date, March 15th. And they told the public declare date that they were going to be paying out this dividend February 17th. And the really cool thing is that this is a company that pays monthly. So every single month, you'll get paid this passive income. And I really like it because when you're getting paid passive income monthly, you can begin to align that with your monthly bills, your cell phone bill, your car note, your car insurance, subscription services like Netflix. You could start to align a lot easier your passive income that you're getting monthly with your monthly expenses, your monthly bills. Boom. Now they're paying for your lifestyle, and now you're able to kind of relax, take some of that weight off your active income, right? Your active income that you're using your paycheck to support your bills and expenses. All right, so here we are. This was a screenshot as of February 20th. These are my balances, my portfolios. October 20th, I was at $1,900 in my portfolio. And literally 4 months later, I grew my portfolio from $1,900 to just under $10,300. So almost $10,000 worth of growth, $8,900, something like that, $8,000 in growth within 4 months. And I didn't do anything crazy. And the reason why I want to spotlight this to the Road to a Million community, right, is because these are all tangible things that anybody can do to get money. These are all the things that I've done for the last 4 months. Those of you that already know me, Curtis G, I'm into photography. I have photography as a side hustle, but even more so than that, I go in my closet and I look and I see things that I don't use. So I sell those things, shoes, old like leather goods, wallets, or, whether it was a Gucci belt or any of that stuff I was buying, that I don't even wear, right? You can sell those things on Poshmark and Mercari and get funds. That's literally what I did. I went on Poshmark, Mercari, sold those things. I took that money and I put it into my portfolio. Shoot, sometimes, if I don't have anything planned, I don't have a photo shoot, I have nothing, lined up for the weekend, I'll do DoorDash, I do Uber Eats, I do it for a few hours in the morning, maybe 2-3 hours at the max. And then one weekend, I could pull in $200-$300 in just a few hours on a Saturday and a few hours on a Sunday, take that money, add it to my portfolio. I literally did that. Reinvesting the dividends. We're going to get into that later. Portfolio gains. So as much as I've added money to this, my actual portfolio grew on its own. What you see here in these screenshots, right, is that back on this particular day, October 20th, this screenshot over here, where my portfolio was at a $1,900 balance, it grew $9 that day on its own. Then over here, February 20th, where my portfolio balance was just under $10,300, it grew $22 that day on its own. So that's portfolio gains. So even though you're adding money to it, the beautiful thing about stocks and investing in the stock market, when you find quality companies, they'll increase in value on their own. I've done some swing trading, which is basically you buy stock on one day and then maybe a few days later, a couple of weeks later, when the share price increases, you sell it at a profit. I took that difference and I put it into this dividend income portfolio. Then there's options trading, and options trading is a whole nother animal. I think it's become very popular these days. A lot of people are talking about it. A lot of people are getting into it. And so that's also another strategy that I use. I use it very cautiously and I don't use it often, but I have, and I do use options trading to fund my passive income portfolio. So one of the things I want you guys to take a look at, take a moment and kind of look at this list and think to yourself, like, what stands out outside of the things that are highlighted? What stands out in your mind? Just take a moment. Check out this list that I've done for the last 4 months, 5 months to build my portfolio value and what stands out the most to you guys. Just take a second, think to yourself to really ask, like, yo, what stands out about this list? All right, so those of you, some of us might have gotten it, some of us might not have gotten it. What stands out, what I want people to take notice is none of this is my 9-to-5 income. So I've been able to grow this portfolio in 4 months from $1,900 to over $10,000 without even using the funds from my 9-to-5 paycheck. And it's extremely important that I show people this because I believe that a lot of us have things around us and opportunities around us to take tangible savings that we come across every day and put that into a passive income portfolio to get more revenue, to get more income. I think there are a lot of things in our daily lives that a lot of us we just skip out on. Like, we don't even pay attention to it. And we realize that that's a savings right there. Like, for example, if you follow me on social media and do that, follow me on Instagram, Curtis G24. You guys can check out my Road to a Million journey. I show all of my lifetime trades, where I get money from, how I add it to my portfolio. But one of the things I did was I had gift cards from the holidays, roughly $275 in gift cards. I exchanged them. I traded them for cash. I took that $275. It was literally Target gift cards. I had $275 worth. I took that money and bought Target stock. So a lot of us have gift cards that we're just sitting on. They're just in our wallet. Exchange that for cash. Exchange it with a family member. Give it to somebody else. You take the literal cash, add it to your dividend income portfolio. It's things like that that we just skip, or we don't really, take an opportunity or take advantage of, that I do on a daily/weekly basis. Anything in my immediate life that I could turn into some cash, I do that so I don't even necessarily have to touch my 9 to 5 income. But just wanted to spotlight that with you guys. I really do this stuff: photography, DoorDash, Uber Eats, sell on Poshmark, sell on Mercari, all of this stuff to grow this portfolio in 4 months. And I think it's just very important because it's things that all of us can do. All of us can do all of this to get our portfolio started. All right. Like I just said, and these are real life screenshots. I try to keep it as transparent as possible. So these are screenshots right here from Uber. I did Uber Eats. You see, this is back in January. It lets you know the amount of hours that I drove on a Thursday and a Sunday. So roughly 3 hours each day. And I got $276. I took that money and I put that in my portfolio. I sold my Gucci watch on one of the Poshmark Mercari websites. You see, I was able to get $100, $375. You know, I sold the Gucci lanyard, Burberry watch. I sold some camera equipment that I wasn't using for $400, some shoes that I wasn't wearing, $100 each. I had a second Burberry watch that I sold for $130. That one was a little bit used, so that's why there's a difference there in the price. But this is real life. These are my screenshots. These are my transactions. These are the things that I really did, right? I also use the cash back from my credit cards. So what I do with my credit card, right, is I'll do all my purchases throughout the month on my credit card so I can rack up the cash back dollars, make sure I pay the credit card off at the end of the month. Then I'll take this $40 of income that the credit card gave me, right, and I'll buy more dividend paying stocks. I'll add that to my portfolio. I just told you guys about the $275 from Target gift cards, selling things on Poshmark and Mercari, side hustle money, photography, DoorDash, Uber Eats, car insurance discount. A lot of us got a discount from car insurance, right, because of the pandemic. I take that $10. It may seem small, it may seem like a minimal amount, but I'll take that $10, add it to my dividend income portfolio and buy more shares, buy more stock. There's things like this that I think a lot of us overlook. These are cash plays that we all experience. This isn't just unique to me. Anybody could get started doing Uber Eats. Anybody could go look in their closet, sell some shoes, sell a shirt, sell a jacket, sell a purse that you're not wearing and that you don't use. Take that income and get your dividend income portfolio started. You take that one sale, right? That one sale, and now you've got money coming into you for the rest of your life nonstop. Now here's just a breakdown of the numbers, all summarized. Pardon me, you guys. So back from when my portfolio was at $1,900, October 20th, it grew on its own $530. So from October to February by itself, because the value of the stocks in my portfolio increased, my portfolio grew on its own $530. Then I took $100 of the dividends that I had been paid, so roughly half at that time, and I bought more stock. So this is how my value grew, right? Roughly over the last 4 months, I made about $5,500 in side hustles, about $3,000 in options and swing trading, and then $870 in tangible life savings, right? And what I mean by tangible life savings is, I'll give you an example. So I normally, here where I live, my refrigerator, where it's positioned, it's not connected to a water line, so it doesn't make ice. And I normally would go to 7-Eleven, Sprouts, grocery store, wherever, and buy a bag of ice maybe once every 2 weeks or whatever the case may be. Well, my neighbors were like, yo, you can use our ice maker whenever you need to get ice. Now, normally that bag of ice might cost $4 or $5 or $3, something like that. And so I take that tangible cash savings. So instead of me having to go spend $3, $4, $5 on getting a bag of ice once every 2 weeks, I'll take that $5 and put it over into my dividend income portfolio. So it's things like that that, you know, it may seem so small, or you might scoff at it, or you might turn your nose up at it. But when you put your ego to the side and realize that's an opportunity right there to take money that I've saved, no matter how small it may be, and I can use that to invest in my portfolio and get dividend income or passive income that's going to be paid to me for the rest of my life, then you start to change your thinking. What we see here at this stage, so back February 20th, I was currently getting, or forecast to get, $660 a year in dividend income. Now, like I said earlier, that's your Netflix membership for the whole year. That's your Amazon Prime membership for the whole year. That's your car registration for the whole year. Just imagine when that once a year comes up, you got to drop that $150, that $200, maybe that $300 in your car registration, right? You don't have to do that anymore because your dividend income pays for it for you. So you ain't got to come out of that pocket. And now that you ain't got to come out of the pocket, you have an extra $330 that you could use to buy more dividend income. So it becomes a snowball. It becomes an effect that like pays itself back and forth, back and forth, back and forth, getting you started on that road to $1 million, right? Okay, so a couple of things I want to talk about. A question that some of us might have is, are dividends considered income? And they are. So you do have to pay taxes on dividend income, even if you do dividend reinvesting, which is a term we're going to dig deeper into. But even if you automatically reinvest your dividends to buy more shares of a company's stock, the government does consider that income still, so you still have to pay taxes. Now, you might want to know, what do those numbers look like? What does it mean for taxes? How much will you be paying? So there's a website called Smart Asset, right? And it has a really great article that talks over the dividend income tax rates for 2020 and the changes for 2021. But to keep it simple, to keep it straightforward, if you were to make $150,000 in dividend income, your income tax rate would be 24%, meaning that Uncle Sam and the government is looking for roughly $36,000. So it just gives you an idea, but go check out smartasset.com and go see this tax bracket, so you'll start to see like where you're getting. Obviously, it takes a little bit of time to get our weight up, right? To start getting like that real bulk share of money. Even me at a $10,000 portfolio value, I'm in this tax bracket here where I'm going to be getting charged the income tax rate of 10%. So it takes time to get the dividends built up, but as long as you develop a consistent behavior, you can see within 4 months' time, I went from 1,900 to 10,000. It can grow. I'm getting $660 as of February 20th in dividend income. So that $660 is taxed right here at this rate. So the government will be looking for roughly 10% of that. But you do pay taxes on the dividend income. All right. So here are some ways to kind of protect yourself. You might have already heard of this. You can do a 401k. The pro to that is you don't pay taxes on that income at the beginning, but at the end, the downside is you will pay taxes later. Another way that you can kind of protect yourself from the taxes of getting dividend income right is opening a Roth IRA. And I won't really go into what these are too much. We'll get into that in another episode where we're chopping it up on Road to $1 Million. But you can use a Roth IRA. And the beautiful thing about a Roth IRA is there's no taxes on any of the gains. What we saw, my portfolio grew $550 on its own. There's no taxes on that. And there's no taxes on the dividends. So when I get paid dividend income, if I were to do it through a Roth IRA, I wouldn't be taxed. The kind of downside is in the short term, in the immediate, your money becomes locked up. And this post-tax money, after you've done your budget for the month, right, paying your bills, showing how much you can allot to investing in your portfolio for your dividend income, it reduces your post-tax money. So it makes things a little tighter, but it becomes a behavior that you develop and everything is all gravy. All right, y'all. Some other uncommon forms of tax protection are municipal bonds. So municipal bonds, they're basically like projects that local governments do, where they want to build a freeway or they're improving like the city's infrastructure. If you invest in municipal bonds, you actually don't have to pay taxes at the federal level for that dividend income. But one of the cons or one of the downsides is typically municipal bonds will have lower yields or lower rates of return, right? Bang for your buck. They'll have lower yields than regular stocks. So that's one downside. And then another downside is that when you're investing in municipal bonds, while you automatically get the tax exemption or the tax protection at the federal level, you have to research at the state level. And just a general rule of thumb, the way that it works is if you invest in a municipal bond that's in the state that you live in, 9 times out of 10, you won't have to pay the state income tax. So if you live in California and you buy a municipal bond that's for a California project to build a freeway or to improve city infrastructure or whatever the case may be, then you won't have to pay the California income tax. Another way to protect yourself from taxes, right, is what they call trade losses. So if you lost any money trading stocks or buying and selling stocks, you can use it almost like a write-off. The bad side is you actually lost money. And if you already have a brokerage set up, your tax docs will tell you how much you lost money and you can kind of write it off. Here's a couple of screenshots of some municipal bonds that I actually have in my portfolio. One is called HYD, that's the ticker symbol, and it's Van Eck Vectors ETF Trust. So they invest in multiple different municipal bonds around the country, and then you get the benefit of a monthly dividend of roughly 21 cents for every share that you buy. And that's protected at the federal level, so I don't have to pay the taxes on it. And here's another example over here. So those are just a couple examples, you guys, of what you can do to protect yourself and not have to pay so much in taxes or pay any taxes on the dividend paying stocks that you buy. All right. So getting into the research. What do you look at? What do you look for when you're buying these stocks that's paying you this passive income? The number one website that I always start with is a website called Seeking Alpha. I think it's one of the best websites out there when it comes to looking at the numbers and the financials for a company that pays passive income dividends. I go to Seeking Alpha first, go to the company's website for investor info, and then the last thing I do is I'll look for the third-party analysts and reviews, people that are not associated with the company, that are writing objective, like neutral opinions about this company's financials and their performance. These are the 3 steps that I always do. Now, there are things after it, but I'm isolating these 3 because I believe that there are the solid 3 steps that you should take before you get on the road and you're buying these stocks, right? Go to Seeking Alpha, check out the numbers, go to the company's website for investor info, and then go check out some third-party analyst reviews. So we could take a look at this company called Realty Income, the one that we had an example of at the beginning of the slide. So let's go over here. Seeking Alpha is already up. We can put in Realty Income. Ticker symbol is O. They got this button called Dividends. This is the website Seeking Alpha. So on the website Seeking Alpha, they've got a whole nice dividend section that talks about the yield, the growth, the safety, everything of that nature. But what we can see here, we'll start off with the dividend scorecard. We can see that as of today, March 8th, Realty Income was trading at about $60 a share. They've got a monthly dividend at 23 cents a share. So every 1 share you buy, they're going to pay you 23 cents a month. But then we could check out their dividend history. So what we see here, based on the data that Seeking Alpha has, Realty Income has been paying a monthly dividend for quite some time without fail. Going way back, just check this out, look at this. Way back to 1994, they've been paying a monthly dividend nonstop without missing a beat. So they're pretty solidified in paying dividend income. So, of course, there's other things of financials that we'll look at, but this is the first step. I always start off with Seeking Alpha. Always take a look at the different numbers, dig into maybe their financials, their earnings, everything of that nature. And if I'm looking at a company and it's chill, it's okay, and I'm okay with the numbers, then the next thing I'll do is I will go to the company's actual website. So let's go check it out. Realty Income. So this is Realty Income. And as I said earlier, they are a real estate investment trust, a REIT. And what they do is they hold commercial properties and they rent it to tenants. Like what you see here is Walgreens. So we can take a look at their portfolio. And a lot of times on websites, they'll have these investor sections that speak specifically to investors like us. So we can check out what they're talking about, right? Let's check out what they're talking about. What they're telling us is that their top 20 clients are Walgreens, 7-Eleven, Dollar General, FedEx, Dollar Tree, LA Fitness, Walmart, Sam's Club, Regal Cinemas, AMC. So these are big names. These are big name companies and they're not necessarily going anywhere. I mean, obviously AMC's had some trouble. Obviously the gym industry has had a little bit of trouble with the pandemic, but for the most part, Kroger, Home Depot, GPM Investments, Walgreens, these names are names that are household names that we're all familiar with it. Most of us visit these places on a weekly basis, right? You're definitely going to Walmart. A lot of us are definitely going by a Walgreens or going by a 7-Eleven or using FedEx. So these are their clients. These are their tenants. And so you'll look at a company's website and kind of analyze something like this to see, okay, does their business model, are their clients in a position to continue to keep paying them? Because as long as they can keep paying their rent, Home Depot can keep paying Realty Income. That means that Realty Income can continue to pay us our dividends. They can continue to pay us our passive income. And then the next thing you do is you'll go look at some analyst reviews. I won't get into that too much right now. It's a little bit boring, but you want to go check out what third parties are saying, outside of Seeking Alpha, outside of the website itself, because obviously they're going to try to show, their advertising to us, their best looks. You want to go see what are some third party analysts checking out. And those are the 3 steps that you want to do whenever somebody tries to put you on to a company. They're like, oh, gee, go check out this company. They pay dividends. What do you think? Do those 3 steps minimum. Go check Seeking Alpha. Make sure you're cool with the numbers. Go check the company's website. Make sure you're cool with their business model, that you understand where they're getting their money from and can they continue to get money. And then third, go check out some analyst reviews, some objective opinions about the company's performance and where they're headed into the future. And if all 3 of those things are looking good, you can continue to do research. There's nothing wrong with that. Or you can go ahead and make that buy some shares of Realty Income, start getting your passive income coming in. All right, let's get back to it. Okay, dividend strategies. So I mentioned this a little bit ago. There's a dividend reinvestment plan. I call it cruise control. And there's special dividends, there's preferred stocks, and then there's options. Let's get rolling on this road to $1 million, y'all. Okay, so a dividend strategy is called DRIP, or dividend reinvestment plan. This is like the common strategy that everybody uses. And what that means is you can literally have it set up to your broker, right? Fidelity, Robinhood, E-Trade, Webull, any of those types of websites, right? And have the dividend income that's paid to you. So what we just saw, Realty Income. Realty Income pays 23 cents a share. You can have that money automatically buy more shares of that company, and then that company now is paying you even more money on your dividends. So that's like a very popular strategy that people use. It's called dividend reinvesting, or DRIP. I call it cruise control, because once you turn it on, you could just sit back and cruise and let that snowball build on its own. Buy your shares, they pay you dividends. Those dividends automatically buy more shares. Those shares pay you more in dividends. Those dividends buy more shares that pay you more. So it's a snowball that just rolls, and you're just kicking back, cruising, and not have to worry about too much. Now, there's one that I kind of developed myself. I call it drips. And it's kind of like sport mode, right? We're out here, we're driving. We're on the road to $1 million. We're out here driving, chilling. And we could turn on sport mode. So what I do is I reinvest my dividends, but instead of automatically reinvesting them back into the same company, I let the dividend amounts pile up. And at the end of each month, I'll take the money and buy some specific companies. So I'll let my dividends actually buy shares of the company in my portfolio that are lower priced, the cheaper companies, right? So I got a company here that trades roughly $10 a share, 11 CDC here, all the way up to about the $28 range. And I'll let my dividends pay for these, and I'll select and I'll choose them, as opposed to having to go automatically back in. Then for my side hustles, or my, tangible cash savings, right? Selling things on Poshmark, doing Uber Eats. I'll take that active income, my side hustle money, and I'll buy the more expensive stock, things like AbbVie that are $105 a share. That's how I play it. And that's what I call drips, or the dividend reinvesting sport mode. Now, if you want the ability to automatically reinvest your dividends, but you don't want them to go right back into the same company, there is an app, there is a brokerage called M1 Finance that will allow you to choose which stocks your dividends buy more shares of. So it kind of takes off the, manually going in there like I do. You can just designate at the beginning, hey, if I get paid, $5 in dividends from Coca-Cola, I want you to take that $5 and buy shares of McDonald's. There's an app, it's called M1 Finance. It's pretty dope. It'll allow you to do that. So go check it out. All right, the next strategy I want to talk to you guys about, want to chop it up about, is called special dividends. And really, this is more so of a warning when you're out here on the road, right? When you're out here on the road, be cautious. I've gotten burned. Like I said, I'm keeping it transparent with you guys. I've gotten burned chasing after special dividends. So at the end of 2020, or towards the end of 2020, Costco had announced that, we did so well financially. We're going to pay our shareholders a special dividend of $10 per share. I came across the article, tried to jump on it right away. You see, this article was produced November 17th, 2020. And you can see here the screenshot from my portfolio. I tried to get in right after I heard about it, November 20th, 23rd, 24th, 25th, and the 30th. I did everything I could to buy as much shares of Costco so I could take advantage of this special dividend. But what happens is, with special dividends, the company, their stock price will spike. As soon as they make the announcement, everybody's trying to get in on it, just like I did. But right after it spikes, then it starts to come back down. And we see these numbers here in red showing that I was losing money each day. The value of the stocks that I bought, because I bought them at the top, because of the hype and the spike, I started to lose money each day. So that's a warning. And I would say, if you're going to go after special dividends, they should be in companies that you plan on holding long term. They should be a part of your portfolio. You should have it in your mind that you're going to hold these stocks for 5 years, 10 years. It should be in a company that you want to rock with for a long, long time. You have to be committed to it if you're trying to play the special dividend strategy. Okay, another company that I chased after special dividend was one called Tredegar. And they were trading at $16 a share. And then they said, we did so well financially, we're going to pay a special dividend to our shareholders of $5.95 a share. What happened is, because the special dividend was more than 25% of the stock price, the SEC activates a rule where they move the ex-dividend date. And remember that ex-dividend date is the day the door closes, right? They move the ex-dividend date to 1 business day after the payment date, meaning that you can't sell the shares after you get locked in as a shareholder to get that payment, to get that qualified. You actually have to wait a day after you get paid before you can sell those shares. And that's kind of where I got burned, because I got qualified, right? I held onto the shares. I got the shares before the ex-dividend date, held on to them. And one of the things I'll make a note of here, just to kind of paint a clearer picture and clarify, when you get shares before the ex-dividend date and it's recorded that you're a shareholder, you can sell those shares and still get paid the dividend. But in the case of Tredegar with the special dividend, when the SEC and the stock market moves that ex-dividend date to 1 day after the pay date, if you sell the shares, you don't get the payment. You don't get that special dividend. And that's what happened with me. So like I say here, only play the special dividend strategy if you already plan on having that company long-term in your portfolio. Okay, another strategy is preferred stocks. And preferred stocks are kind of like hybrids between regular stocks and being bonds. So some things to consider is that preferred shares have no voting rights. So as you start to invest in companies, right, and you start to buy stocks, you'll get an email from your brokerage, Fidelity, E-Trade, whatever the case may be, and they'll say, hey, there's something going on with the board of directors of this company. You have shares and you have voting rights. Well, that's with regular stocks. If you buy preferred stocks, you don't have any voting rights or any say-so for those meetings that come up. The next thing to keep in mind about preferred shares is that they can be postponed. Now, the next thing after that is that preferred shares can also be paid in the form of regular shares. So you might invest in a company that has preferred shares, right? And you're trying to capitalize on those dividend payments. They could turn around and say, hey, we're actually not going to pay you the cash. We're going to give you shares of regular stock. But another consideration to keep in mind about preferred shares is that they get paid before regular shareholders. So keep those cautions and considerations in your mind where you're out on the road and you're investing in these different companies and you're playing this preferred share strategy. Now, let me go into a little bit more detail about preferred shares, because the key thing about preferred shares is what I've seen and what I've learned is that preferred shares are typically way more expensive than regular shares. We've got some examples right here, but the dividend yield, right, is a lot higher than getting regular shares. So back at the time when I took these screenshots, this is the ticker symbol for Bank of America. And when I took this screenshot, Bank of America was trading at $31.55 a share. If you bought one share, you would get an 18-cent dividend. However, if you took that same money, $31.55, and bought a fractional share or part of the share, and oh yeah, you can do that. If people underestimate it, don't let the price or the amount of a stock, the share price, scare you off from investing. You know, a lot of people, we see Amazon and we get scared off because Amazon trading at more than $3,000 a share. You can buy fractional shares. I always buy fractional shares. You know, if I got $100 in my pocket to invest or in my account to invest, I'll buy as much Coca-Cola as I can. It might not equate to 3 full shares or 4 full shares. The app, the brokerage will buy as much as it possibly can with that $100. So back to the preferred stock. You can take the $31.55, and at that time, Bank of America's preferred shares was trading at just over $1,400. But that $31.55 now becomes 38 cents in the preferred shares side of it. So instead of buying the regular stock, BAC, you can buy the Bank of America preferred shares and your money's going longer. Here's another example here. And this is a company, AVGO, which is Broadcom, that I have in my portfolio. At the time of the screenshot, it was trading at, this is the regular share price, $465 a share. You could have bought one share and they would pay you $3.60 a share. Buy one share of Broadcom at $465, you're going to get $3.60. Or you can go over to their preferred shares. At that time, it was $1,500 a share. Don't let the price scare you, because you could buy fractional shares, but they're paying a dividend of $20. So that $465 now becomes $618 if I bought the preferred shares. So just a few examples right there that I wanted to go over. A couple of examples. I got another one with Zions Bank Corporation, but these are just some few examples of showing how your money could go further if you invest in the preferred share side. And what you'll notice is, what a lot of us don't know, is this is where the big money buys shares. When you're looking at a company's breakdown, you'll see that mostly the institutional investors are the ones that are playing with these preferred shares, the banks and the big financial houses. But individual people, you guys can buy these too. We can buy these shares too. To buy fractions of them. You need to buy the full share at 1,500 or the full share at 1,400. You can buy a fraction and still get the benefit of a higher dividend yield or more money, more passive income. Okay. Another dividend strategy is options trading or swing trading. I'm going to focus specifically on options trading. And I equate options trading to like NOS in your car. I don't know if you guys remember like the first Fast and the Furious movies, right? They were using NOS to boost up the car to make it go faster. It's the same thing in my opinion. If you're options trading, it could be like NOS and boosting up your ability to add money to your dividend portfolio so you're buying more passive income. But what's the thing about NOS? It's very dangerous. You know, a lot of those racers that were using the NOS, you really had to know what you're doing because you're injecting that gas right into the car's engine. So you really got to know what you're doing when you're using NOS, aka options trading. It's very complex. I'm not going to front and act like I'm an expert, but I have done it and I do use those funds to increase my portfolio value. So some cautions and considerations to keep in mind, y'all. FOMO will get you wrecked. And FOMO, for those of us that don't know, is fear of missing out. With options trading, and really in general with the stock market, but specifically and especially for options trading, if you get the fear of missing out feeling and you try to jump into an options trade or an options play, you will get wrecked. It will bite you. You'll shoot yourself in the foot. You don't want to mess around with it. So if you're hearing about something booming off and you feel like you're missing out, don't get into it. Have a little bit of control, discipline, and take a step back. Another thing to keep in mind is that they're extremely complex. There's a lot of moving parts when it comes to options trading. It's 100 times more volatile than regular stock trading. And you should definitely, I mean, this is a kind of like an old adage or old phrase that they'd always talk about with investing, but more so it's super important with options trading is you should only use money that you're 1,000% like beyond okay with losing, because the money goes super fast. But it is something that I do use. I'm keeping it a buck with y'all, keeping it full transparency. I got real live screenshots and I just wanted to show you. So this first screenshot right here, kind of on the left-hand side or in the middle of the screen, is a screenshot from a day that I did an options trade with Amazon right here. That's their ticker symbol, AMZN. I did an Amazon in one day. I made $1,200. This was in one day doing options trading. So you can see it's very powerful. But at the same time, I was willing to risk $3,100. This options play cost me $3,100. So 3 Gs, 3,000. I put 3,000 down on the line. You got to be extremely comfortable with losing that. But I was able to make 1,200 on top of it in one day. So it's all gravy when it works. It's all gravy when it shoots up. You're able to make that money in one day or however amount of time using options trading. I took that $1,200. I put it in my dividend income portfolio and I used that to buy more passive income. So this is one of the strategies that I use. But let's keep it full transparency. Even with me, I let FOMO get me wrecked. And here's an example of what could happen in one day. So we saw in one day I could make 1,200, but here's an example of what happened in one day where I let FOMO mess me up. And this is an options play for CCIV, which has been in the news lately, pretty popular for a big deal that they did. But here's what happened when I just didn't take a step back. So you see right there, in one day, I lost $720. In one day, $720. Just as fast as I made this 1,200, I lost 700. So it's very important to keep that in mind with options trading. It's extremely volatile and it moves super quick. And you should only be using money that you're comfortable with losing. And understand it's like NOS. You can boost up your portfolio, your dividend income portfolio. You take this money, $1,200, put it over there very fast. But it could also get wrecked very fast. So keep that in mind. But it is a strategy that I do use to boost up my dividend income. All right. So this is kind of like an overall summary snapshot. I won't go into it in too much detail, but it's like a fluid, evolving strategy that I have for my portfolio. So what I did was I started by building positions or in several companies to get frequent payments. So a lot of times, the experts, the gurus, the OGs, Warren Buffett's, Charlie Munger's, guys that have been in the investing world for a long time, they suggest that individual people like us, we only focus on maybe like 5 or 6 companies to have in our portfolio so that we can truly understand what these companies do, their business models, and that we're investing in companies that we believe in and that we're knowledgeable about. But me, to really get things tangible and me understanding the bit that I've learned, what I did was I invested in several companies. So as you saw at the beginning, I can get several payments frequently all throughout the week and all throughout the month. And the reason why I did that is so that I can get used to seeing the money coming in, and it keeps me motivated. Any given time, I can open up the Fidelity app on my phone, see that I got paid, and it motivates me to be like, cool, let me keep adding to this. Let me keep adding to it. So I got several companies. I bought several companies so that I can get several payments to keep myself motivated, to keep myself disciplined, to continue to add to my dividend income portfolio. The way that I play which companies I'm going to buy more shares of is I'll look for the ex-dividend date. So here's a snapshot on Fidelity of the dividend view, right? They have a dividend view and it shows all the ex-dividend dates for the companies that you currently own in your portfolio. So here we are, it's March 8th, and the ones that are coming up are Merck, VGI, Shaw Communications, Brookfield Real Assets. These are coming up within the next week. So these would be companies that I would be added money to because the ex-dividend dates are soon, and I would get the benefit of these soon payment dates that are coming up as well. Now, another thing that I do is at the end of each month, I'll take half of all the dividends that I got paid. So I'll take half of that money, right? So let's just say it's $100 that I made in dividend income 1 month. I'll take $50, use it, as I said earlier, to buy more shares. More than likely, I'll play the ex-dividend date, and then I'll focus on the companies that are cheaper in price. Then I take the other $50 and I put that aside in another account that's not vulnerable or exposed to the volatility of the market, of the stock market. Now, there's 2 reasons why I do that. I do that for market protection, and I do that for the next passive income source. And what you guys will see as a community, right, as a team, we're not just going to talk about passive income through dividends. We're going to talk about passive income through rental properties. We're going to talk about passive income through being able to invest in other businesses that you can just sit back and collect a monthly paycheck, right? So I move half of my dividends into another account because I will be investing in getting a rental property, and I want all of us to be on that journey together. Cool. Now, for 2021, the big bulk of my strategy, I call it like the Warren Buffett style, is I'm going to invest in American companies with a global footprint. So these are the big names that we've seen growing up all of our lives. Coca-Cola, Pepsi, Caterpillar, huge companies. They've got a footprint and a brand all over the world. So not just in America, Mexico, the Middle East, the Philippines, Japan, China, huge American companies with a global footprint. That is the core strategy for my dividend portfolio. All right, couple stock thoughts for the road. If a stock price or share price seems expensive, I want you guys to go back to your savings account and look at what they're paying you in interest. If a stock price or share price seems expensive, go back to your savings account and look at what they're paying you in interest. Look at what the savings account is getting in interest, and then remind yourself that, hey, I can buy 1 share of a company and get more money from the dividends than I will an entire year from my savings account. Don't underestimate the power of buying fractional shares. I take whatever amount of money I have on hand at that time and I buy shares. I don't concern myself with whether or not it's going to be a full share. So, for example, if ABC stock is $400 per share and is paying a $2 per share dividend, but you only have $200, use the $200 to buy half of a share, and you'll still get half of the dividend, $1 in this case, in this scenario. And when the stock price goes up, so will your $200. I'll give you an example. So another portfolio that I have, it's a growth portfolio, but I just wanted to show you guys a live example, going back to me keeping it transparent as possible about the power of buying fractional shares as it relates to like the stock price going up. Is I bought Tesla back in 2020. You can see here on the screen. In August of 2020, I spent $87.40 to buy a fraction of 1 Tesla share. As of the date that I took this screenshot, the current value of that $87.40 had increased all the way up to $226. So I had gained almost $140 in value. So Don't underestimate the ability to buy fractional shares. Do not underestimate. Take whatever money you got that you can. I don't care if you're looking at a stock that you're interested in and the share price is $500, but you only have 20 bucks to put down. Throw that $20 down. It will grow. At the time that I threw this $87 down, the cost price for Tesla was $301 a share. So I bought a small fraction and I still got the benefit of it growing 140 bucks. So don't underestimate the money that you got on hand. If you got 20 bucks, use that 20. If you got 15, use that 15. If you got 50, use that 50 and buy fractional shares because it's extremely powerful. And a lot of times we underestimate it. All right, a couple of resources. Seeking Alpha, as you guys saw, I use that website. That's the core of where I start. I always start with Seeking Alpha. There's a YouTube channel by a cat named Joseph Carlson. He has a very clear, thorough way that he researches his dividend paying stocks. Go check out his YouTube channel because it'll get you into that mentality. It'll help cultivate that mind frame of what you should be looking for and determining if it's a quality company to invest in. Another little cheat code you can look at, like I said, is the Warren Buffett style. You can actually Google the current holdings of Warren Buffett's Berkshire Hathaway portfolio. As a matter of fact, we can go take a look at it right now. This is one thing that I do too. So you can just do, boom, Warren Buffett current holdings portfolio. And what we'll do is go to the CNBC. And, we'll check out, hold up. Warren Buffett. Hold on, y'all. Berkshire Holdings. Oh, spelled that Berkshire wrong. All right. So they got a portfolio tracker. And this shows the holdings of Warren Buffett and his company, Berkshire Hathaway, as of the end of the year, December 31st, 2020. This is what they filed February 16th, what they told the government. These are their holdings, right? And you can actually sort this list and manipulate it. We see AbbVie. AbbVie's in my portfolio. We see, Coca-Cola. That's the famous one that Warren Buffett is really known for, one of his best investments. So I'll give you guys, you can sort this, right? Check it out. So if you wanted just like a list or a guide of companies to check out to invest in, I definitely refer back to this list if I'm thinking about adding a new company. Chevron, all of these different companies that Warren Buffett is investing in. So you can just Google Warren Buffett Berkshire Hathaway Holdings, and you can get a list of what they're currently holding, what they're currently invested in. Warren Buffett is huge on dividends. He's been talking about dividend investing, dividend income for decades now, for years and years and years. So this is like a good starter point for those of us that are just starting out in the game. All right. And then Yahoo Finance. Yahoo Finance is another great resource. It has a really good, easy to move tracking of a chart price, stock price. So if you wanted to look at how a company's stock has gone up and down over X amount of time, Yahoo Finance has a great interface for that, and also great articles. You can find those third-party articles I was talking about, neutral analysts and them giving a review on a company's performance going into the future. All right. So I thank y'all for rocking with me, man. For anybody that tuned in just for a little bit, for anybody that stayed the whole entire time, for anybody that viewed, this was just the first episode, right? Young, Black, and in Business with Curtis G. We're tag teaming. We're teaming up together to get everybody on this road to $1 million. We're building a community. We're building a team for all of us to be able to share ideas, to educate each other on getting passive income, building a portfolio. We're starting off with these dividends, but we're definitely getting into rental properties this year. We're definitely getting into investing in businesses through equity ownership to collect passive income. So I appreciate each and every single one of you guys for rocking with Curtis G, Young, Black, and in Business, Road to $1 million. I'm looking forward to us getting on the next episode in a couple weeks. We got more current events to talk about, more strategies. We're going to take a current look at my portfolio, the current value. I want you guys tuned in so we could chop it up and have much more of a live discussion. But this was just episode 1. I'll see you guys out there on the road.